So one of the concerns about why you should do Roth conversions in your, say, 50s or 60s is to try to reduce that RMD. So just a reminder, RMD is a required minimum distribution. It is a divisor based upon how many years you're likely to live, so on and so forth, that the government actuaries put together.
Yep.
You're typically going to be paying around 4% of the value of the account starting at age either 73 or 75, depending on whether you were born before or after 1960, right?
Not to say that Roth conversions are not valuable. They can be very valuable, depending upon the circumstance. But what's very interesting, and we've been doing so many of these for so long, and especially now that the tax rates are not going up next year, they just quite frankly are becoming far less effective.
Yeah.
Just doesn't always fit for most people. Yeah. And they've been fed Roth conversions for so long as a tax planning strategy in retirement, and it's just not nearly as effective as it used to be. All right, welcome back for another edition of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn, Family Wealth Planning Partners. Thank you very much for joining us. Today's going to be an interesting conversation, I think. So we've been having this conversation a lot lately with clients since the passage of the big, beautiful bill recently. And one of the big results of that, or one of the big pieces of legislation that was included in that bill, was the extension of the tax cuts.
Right.
The temporary tax cuts.
brackets, yeah.
Exactly. So that the tax brackets were basically, or the tax rates were essentially made permanent. The Trump tax cuts that went into effect in 2017.
Yep.
2017. Those are made permanent. So there is no looming threat of everyone across the board getting on average about a 3 to 4% increase in your federal tax rate. Alongside of that, we've been having a lot more conversations around the viability of Roth conversions. And we're definitely going to be talking a lot about conventional wisdom here.
Yeah.
And
let's be clear. The reason that Roth conversions have been such a hot topic for the last, 8 years or so is because we knew that those tax brackets were going to sunset. And the argument that was made was, get your conversions done now because it's cheaper to do it now.
Because taxes are going to be going up in the future, and
Yeah.
we know that for a fact, right?
Right.
But conventional wisdom, generally speaking, is that Roth conversions are always good. And you should go ahead and pay taxes at today's rate and avoid paying taxes in retirement at a greater clip, right? And I hate conventional wisdom. I hate maybe that's a contrarian in me, but anytime I hear the phrase conventional wisdom, I'm looking for something that is,
Hair stands up on the back of your neck when you hear that phrase.
What are you not saying? What are you leaving out, right?
Yeah.
So I hate that term with a passion, because conventional wisdom says that you should always look to do Roth conversions as a financial planning strategy. Not to say that it's always a bad strategy, but we're going to talk a lot about that today and whether or not it's truly as viable as conventional wisdom in our industry.
I think you just gave a little hint of which direction we're going to go with this.
Oh, absolutely. Absolutely. So not to say that it's not ever viable, and we will give some examples very, very specifically of when it is absolutely 100% very, very viable and a great thing to think about doing. But with that being said, you have a fantastic bourbon here that I've never tried.
Let's talk bourbon. Okay, so what we are drinking today is Little Book. This is chapter, I believe this is 9. It's for the year 2025. So a little background on this. This is a Jim Beam product. So if you follow bourbons, you've seen all these. Back in the early 90s, I believe it was, the Jim Beam company came out with what they called the small batch collection. So there were 4 of them in there. I remember when they were selling these as a package. It was the first time I ever tried it. The 4 small batch would be Knob Creek, Baker's, Booker's, and Basil Hayden, or Haydn, however you say that. Well, they did very well. You can still get all of them, but as time's gone on, they have released a lot of variations on those. Okay, so Booker's, which is what we're dealing with right now, was named after Booker Noe, who was one of the master distillers. Now, Booker's long gone. His, and I may be saying this wrong, his grandson, Freddie, is the current master distiller out there. So Booker's was named after Booker, and he called Freddie his Little Book, right? Mm-hmm. That was just his pet name for him when he was a kid. So Freddie came up with the idea, I don't know if it was his idea or somebody else's, but they call this little book, and it's basically a high-end version of Booker's. And there is a high-end version of this, too, called The Infinite. They've only had one release of that, and I have had it, and it is unbelievable. But if you've had Booker's is very good, but it is screaming hot.
Mm-hmm.
I mean, they're typically
Booker's,
in the 120 to 130 proof range, and you're going to feel like you're drinking 150. Mm-hmm. I mean, it is screaming. It's not a Kentucky hug. It's a Kentucky got run over by a truck. But, I mean, great flavor, but it's really, really hot. When they came out with the little book, because this is a high-end version, it's still fairly high proof. In fact, this one, let me double check.
121.
121 proof, and this is actually a blend of 5 different things. It's 8-year-old Kentucky rye, an 11-year-old Kentucky bourbon, a 7-year-old Kentucky bourbon, another 7-year-old Kentucky bourbon, and an 8-year. So the youngest thing in here is 7 years old. That should tell you something right there. When you go to the Booker's, it's all out of one basic batch, so there's a specific age, whereas this one is a blend of basically the really good Booker's. So that's what we're drinking today. This is Little Book. They release one a year. They call them chapters. This is number 9. Like I said, it comes packaged. I'll get this out. It's kind of big. It comes packaged in a box. Now, Booker's has a brown kind of a wood grain box, whereas the Little Book is done in black. This is one of the better presentations that you're going to see in the bourbon world. I actually have a friend of mine that took one of these, and he cut a little hole in the back where he could insert a rubber tube. You could stack whiskey glasses if you use the right size and you stack them just right. So he made old fashions, and he could get 3 of them in there, put the cover back on it, and then he pumped smoke, from oak or whatever. It was a smoker, but it was literally smoking 3 glasses at a time. And he did that at an event over at his house. And it's like, oh my gosh, Craig, that's the coolest thing I've ever seen. So even the presentation of these is great. They look great up on a shelf if you got a collection. But these are not cheap, and they are, once it's gone, it's gone. The 2025 where you're drinking right now is still relatively available at liquor stores in the Louisville area. But I would say probably, we're recording this mid-September. I would say realistically by the end of October, Thanksgiving at the latest, you're not going to see this on the shelf anymore unless you're paying a premium for it.
That's what we're drinking. I think we're officially late September now, by the way. But
okay, that's true. It's like going to be 88 degrees today, but next week it's going to be in the 70s. So.
Year's going by a little too fast.
Yes, it is.
Sure.
So the Little Book, Chapter 9, 2025 is what we're drinking today.
Mm-hmm. Oh, absolutely. So we'll give a more thorough review here in just a little bit. So Roth conversions. Let's talk those, right?
All right.
When someone walks in the office, what are some of your main talking points when you talk about the viability of doing Roth conversions? And we can maybe go from there, because I've got a few bullet points that I want to make sure we hit. But generally speaking, we bring this up very rarely, at least in my experience, do I need to bring it up. The client usually does. Which is usually the case, yeah. Because there's so much press about it in our industry. It's one of those things where it gets talked to death. And so I think so many people in our shoes feel like they have to talk about it and they have to offer it, because I think so many clients are probably expecting some level of conversation about it.
Well, okay, so here's, just to give anybody who doesn't know a background, all Roth conversion is you're taking money that's in a traditional IRA. Remember, no taxes have ever been paid on that money. That's kind of the point. Mm-hmm. Whereas a Roth, all of the taxes that are ever going to be paid on that money have already been done. So when you convert, that's a taxable event. But the big selling point, the reason that people come in and they bring the subject up is, once I get that money in my Roth, I will never need to pay taxes on it again. Whoever inherits this money, if I don't spend it all while I'm alive, they will never have to pay taxes on it, blah, blah, blah. And that sounds fantastic. And it is, when we're talking to people who are 20s and 30s, and I think we're probably going to go down that road next.
Yep.
If you have a Roth option, you should absolutely be taking advantage of it.
Very much so.
And the reason for that, I've always used the analogy of the snowballs rolling down the hill. I've done that on this podcast before. I won't do it again. But if the hill is long enough, the Roth snowball will win every time, right? But that's talking about it starting off with the Roth, right? What we're talking about here is converting from an existing IRA into Roth, and that's a different animal altogether. But yeah, that's people come in and they ask about it. And we've said this before, very, very rarely do we see a circumstance where it is in their benefit to do the Roth
during their
conversion
during their lifetime.
Bingo. And the reason that we've always talked about is unless you can cash flow the tax burden. So let's say you're going to convert X number of dollars, and the taxes on that is going to be, let's just say $5,000. Just to throw out a nice round number. If you are taking that $5,000 out of the IRA just it gets put in a pinch, right? It's just never going to catch up. So you have to cash flow that. You have to take that $5,000 from somewhere else in order to make the Roth conversion
some type of savings
viable.
or taxable brokerage account or somewhere other than the conversion itself.
Yep.
So if you are having to pay the taxes on the conversion from the conversion itself, instead of, let's say, you're converting $50,000, and in this case you're maybe paying 10% in taxes, so there's that $5,000. Well, you're losing $5,000 in tax deferred future potential growth.
Right.
So it kind of defeats the purpose of doing the Roth conversion in the first place if you're having to take money out of tax deferred growth or tax. And of course, when you move to the Roth, then it becomes tax free growth, right? But if you're eliminating the amount of principal in that account, you're kind of cutting you're cutting yourself off at the knees, right?
Yeah.
It doesn't become nearly as viable or nearly as effective unless you have the money set aside in a taxable brokerage account, whether that's a savings account at the bank or some other individual transfer on death
something
account,
that
whatever.
is not going to be taxed as income.
Exactly. So really, unless you have a decent amount of money sitting aside that's liquid, that's available to you in a non-retirement account to be able to cover the tax burden, I've never seen a situation where it's worth it to pay the taxes from the conversion itself.
I agree, and I'm going to take that a step further. It's even worse if you're taking the taxes out of the IRA, if you're under 59 and a half years old, because that's considered a distribution. It's an early distribution because you're too young, and therefore the taxes are subject to a 10% penalty. And when I say subject, you're going to pay that 10% penalty. That's not an optional thing, right? So it's even worse if you take that approach when you're under that age. However, it doesn't matter what your age is if you're paying the taxes from elsewhere, right, to your point.
So to start things, that's probably a pretty good place to start things, because if you don't have the money set aside in some other taxable account to be able to cover those taxes, this is really a non-starter for you. And the rest of this conversation really is not even going to be applicable in any way, shape, or form anyway, for the most part. So with that being said, you talked about the snowball, and you use that analogy. And if you start young, right, and you let that snowball grow tax-free over the course of your lifetime, that can become a very, very large snowball, right?
Absolutely.
And so, yes, this isn't a conversation about whether or not Roths are effective in and of themselves. If you are younger and you have a long time horizon, Roths are infinitely valuable. Every time. Especially if you start when you're younger and you're probably at a much lower tax bracket. As you get into your peak earning years, when you get into your 40s, 50s, 60s, prior to retirement, if you've already got money set aside in a Roth that you already paid taxes in at a much lower tax bracket, that's still continuing to grow for you tax-free.
Right.
Very, very valuable. But in and of itself, what makes a Roth the most valuable is the time horizon. The longer you leave it alone, the longer you let it grow and compound,
the bigger
tax-free,
the deal that is. That's right.
The bigger the benefit of the Roth is, of the contributions to the Roth IRA are. That's why it's so important to start when you're young. If you are doing a conversion when you are in your 50s or 60s, the viability of doing a Roth conversion or the effectiveness of that Roth conversion becomes less and less every year that you're older. So every additional year that you're older, that the viability becomes less effective. It just does, because you don't have the runway ahead of you to be able to recoup the taxes that you had to pay on the conversion itself. Or even in this case, if you're talking about new Roth IRA contributions, because you have to pay the taxes up front, sometimes you don't have enough runway to even recoup the taxes that you paid in the first place. Right? And that's where it becomes a conversation of, okay, well, what's your current tax rate versus future tax rates? And if you're, in a 32% tax bracket, well, yeah, there's definite benefit to putting money in pre-tax and not having to pay the taxes up front, versus, maybe potentially paying tax brackets at a lower rate down the line in retirement, which, of course, we've talked about that as a myth, and most people, that's not the case. Most people don't take a pay cut in retirement, but that's the math that we have to figure out and how viable that is.
So, okay, so I want to kind of go with something that you said. The Roth is more viable because of the time frame.
Yep.
Right? The reason why somebody in their 20s or 30s who is just getting started in their retirement investing, the Roth is going to win every time there because they have such a long window. Where we kind of went, you're talking about somebody in their 50s, like me, for example. If I was doing conversions at this point in time, and I was your typical person who's going to retire sometime in their early to late 60s, that's kind of the normal time frame. I don't have a really, really long runway for that Roth to take advantage. Now, where that leads into is an article that you and I were both looking into. Shout out to the guy who did this. Most financial planning software. So if you are working with a good planner and they're going through their software,
and we do it,
and we do this. Yep. It says, hey, a Roth conversion makes a lot of sense. You should do that. Most all of the software does that, the good comprehensive software. But here's why, and he had a great point. The default setting on most of those softwares is that you will live until age 95. Now, the reason that they do that, and we do the same thing, is even though statistically you are unlikely to live that long, we have to run your plan out longer than what you're likely to live, because the biggest concern that people come in with is, I'm worried I'm going to run out of money.
And that's the biggest problem we have to solve.
Absolutely. So that's what we call longevity risk. What if you live longer than what you planned for and you run out of money? So that's a primary concern when we're doing those. But if the only thing that you're planning for is dealing with that longevity risk, so we're taking your plan out to, 95 or whatever. And obviously every client is unique, but that's kind of the gold standard. I've got one client that we actually wrote his plan out to 105 because both he and his wife have extreme longevity in their families and they're very healthy. But that's an outlier. 95 is kind of the normal thing. Well, what happens if you build this plan out and you do these Roth conversions, in your 60s, based on the fact that you're going to live into your 90s, and then you don't live into your 90s, right? You shorten that runway, and you never really get the advantage of the Roth conversion, and that's kind of the point. So if we take your plan, right, so we build you out to 95, for example, and we say, okay, it makes a lot of sense over the next 5-10 years to do a series of Roth conversions of $250,000, just, for a number. And then you only live to 85 or 80, right? We're shortening your lifespan by 10 or even 15 years from what that original plan was written. All of a sudden, that $250,000 conversion is not even approaching in your best interest.
Yep.
Right?
No, for sure. And we're not going to get too terribly wonky with specific examples. Right. There's plenty of videos on YouTube if you want to go find them where people are showing charts and data. And if you have X amount of dollars and you do this percent, we're not going to do that, right? We're going to talk a little bit more in generalities. If you want to see that, schedule an appointment and we'll do that for you. But we're not going to do it for the purposes of this. But ultimately, yeah, it's all about your time horizon. How much runway do you have ahead of you to be able to recoup the loss of the taxes that you have to pay? And if we're talking to you and we're putting together a retirement income plan, and unfortunately, I say unfortunately, just it is what it is, because conventional wisdom says people should have been maxing out their 401ks over the last couple decades. Well, it was a good problem, but a lot of people listen to that. A lot of people listen to the conventional wisdom that says you should max out your 401ks, take advantage of the matches, obviously. But now we have these people, these retirees that are coming into our office with massive 401ks as they enter into retirement. And that's pretty much the main bucket, because that's their retirement account. Yep. That's the main bucket that they save to. So they don't have the taxable account to be able to pay the taxes on any Roth conversions. And once again, they don't have the runway ahead of them to even make those Roth conversions viable within their lifetime, for them to benefit from the tax savings within their lifetime in most cases. Another thing that we haven't really talked about is spending risk. So we talked about longevity risk, but there's also when you do massive conversions kind of at the beginning of your retirement, you are adding a level of spending risk into your retirement. What do I mean by that? Okay. Well, if I'm going to convert, let's say $100,000 and I need to cover, let's say a 25% tax bill, 25% tax bill. Well, I'm losing $20,000 to $25,000 in taxes that I'm having to pay up front in order to convert the $100,000. Well, that's reducing overall my net worth, right, on paper. Now, I know you can say, well, you didn't really have that net worth because you had to
because
pay
you owe taxes
anyway.
on it, right?
But at the end of the day, you have $25,000 less in a taxable account that could be used for spending needs in the near future. So you are, to some degree, cutting off the availability of money that you have to spend throughout the first several years of your retirement if you are doing massive Roth conversions early in retirement. So there is a little bit of risk that you are adding, because if you're increasing spending risk, you're also increasing longevity risk to some degree, because you're reducing the amount of money that you have available early on in your retirement to grow and compound over time. So that's another thing that needs to be taken into account. A lot of people don't talk about that. Everyone likes to scare clients with taxes. Everyone's scared of the IRS, and you have to pay the tax monster. It's not always that bad. You're going to pay taxes one way or the other. Pay now, pay later, but there is a risk of paying now, right? Because you're going to lose the ability to grow that money that you're paying today. So it's once again, it's not the end all be all, but it is a consideration that doesn't get nearly enough coverage when people are kind of just massively throwing out the idea of doing Roth conversions.
So I can't read your notes here. I know you've got it kind of organized, but you kind of led into something else. I don't know if it's next or not, and that is RMDs. So one of the concerns...
You're skipping one, but yeah.
Okay, so I'm skipping one. Sorry about that. So one of the concerns about why you should do Roth conversions in your, say, 50s or 60s is to try to reduce that RMD. So just a reminder, RMD is a required minimum distribution. It is a divisor based upon how many years you're likely to live, so on and so forth, that the government actuaries put together. You're typically going to be paying around 4% of the value of the account, starting at age either 73 or 75, depending on whether you were born before or after 1960, right? So RMDs are a little bit terrifying to some people because what you're talking about is how much you're going to have to pay in taxes. But when we get to RMD age, what we're talking about is the government is going to mandate that you start paying those taxes. And the way that I've always explained this to clients is the IRS has been patient. They have allowed you to grow your money in this tax-deferred account. That's why it's gotten so big, but they want their money now, right? And they lose their patience when you get into your early 70s. So the concern is if I do Roth conversions, it reduces the amount of RMDs that I'm going to have to do. And more importantly than that, because we know we're not going to convert everything, there's no sense in doing that. It's the concern that the RMDs will bump you into the next tax bracket. So let's attack that one, for example. And I'll let you kind of walk everybody through that one, but I want to preface it by saying, remember that we have a progressive tax system. This is not I'm in the 22% bracket, therefore I pay 22% on everything. Or I'm in the 32% bracket, therefore I pay 32% on everything. That's not how it works. You went through and printed out some current tax brackets here. The current brackets are, just to let everybody know, they are 10, 12, 22, 24, 32, 35, and 37%. Everybody's in the 10% bracket. And then once you make more money than what's in the 10% bracket, then the next dollar above that is at the 12% rate. And then the next one is the 22, and then so on and so forth. So everybody uses, your marginal tax bracket is based upon if you made $1 more than what you did now. It would be at that rate.
That's the highest tax bracket that you pay taxes into.
So I'll preface what you're about to talk about by saying, remember that the next dollar is in that. It's not that if I bump into the next tax bracket, all of the money that I've already made is suddenly going to go up in the amount of taxes that I paid. That's not correct. So go ahead and take it from there on the RMD brackets.
Well, the idea is that the RMDs are going to be so big when you get into your 70s, at the time when you have to start taking the money out, that you're going to be paying into a higher tax bracket in perpetuity for the rest of your life. Mm-hmm. Do you just get surprised by that drink or something?
No, I picked up a flavor that I didn't get the first time. We'll come back to that.
You just look very shocked. You just had a very shocked look on your face there. So, but the idea is that you're going to be paying at a much, much higher tax bracket at RMD age. Well, if you look at today's tax brackets, yes, that might potentially be true. But one thing that goes unsaid with a lot of these projections is the fact that tax brackets change every year based on inflation. Mm-hmm. So we're not necessarily changing the tax rates then in and of themselves, but the tax brackets themselves change and they adjust typically by inflation every single year. So when you're looking at, let's say, the married filing jointly tax bracket of 22%, any money that you make between $96,000 and $206,000 is going to be taxed at 22%.
Right.
Well, next year, and we won't know until they release the new tax brackets, as we get closer to 2026. But next year, that number could be something like $99,000 to $210,000.
Right.
I don't know, but it'll be somewhere along those lines. So these tax brackets increase exponentially every year based on inflation. Mm-hmm. That usually is not included in most Roth conversion calculations.
Right, because they don't know what it's going to be. There's no way to calculate.
They don't know what it's going to be, and they use today's tax brackets to assume that they are going to be like this in perpetuity. Mm-hmm. Another thing to keep in mind is that, historically speaking, we have very low tax rates.
Right.
I know people don't like hearing that. I don't like saying it, right?
Well, it doesn't seem like they're that low. I can hear my dad saying that right now.
Yeah, because if it was up to me, I would definitely prefer lower taxes. So do not misunderstand that anything that I'm saying right now. I would very much prefer a lower tax rate than what we're all having to pay. With that being said, historically speaking, we do have some of the lowest tax rates that we've ever had. Mm-hmm. Definitely since the early 80s when Reagan made his tax cuts early in office, but we're going back 40 years, right? And before that, they were astronomically high. So we have some of the lowest tax rates we've ever had in the history of the United States. Yeah. The lowest tax rate right now is 10%. That's the lowest it's been since before World War II. Mm-hmm. And think about what the debt was pre-World War II, right?
Right. Yeah.
and
we didn't have the problem we've got now, right?
And same thing with the highest tax bracket. The highest tax bracket at 37% is still, with the exception of the Reagan tax cuts that happened in the 80s. Prior to that, we didn't have rates this low at the highest level since pre-World War II.
So let me jump in here for a second. When we hear the phrase, and you and I were talking about this before we started recording, when we hear the phrase that taxes are the lowest that they've ever been, what we're typically referring to when we talk about that is, what is the highest tax bracket? Currently 37%. But historically, since the invention of the income tax, which I believe was 1915 or 1916 or something like that.
Sure.
So those people who voted in favor of it and made a constitutional amendment for it back then, it's your fault. But anyway,
thank you.
Yeah, thank you very much. Appreciate that. The average highest tax bracket over that period of time, according to this chart, is 56%. Well, currently it's 37. We're way below that. But to your point, after World War II, where we had, a huge war debt that we had to pay off, that number spiked. And if I remember correctly, it was 95 or 96%. Now imagine you're in a tax bracket where your highest amount that you're paying, that highest bracket, was 90+% of your income. And that's just the federal side, right? That's kind of a shocking number. And it stayed that way for a long time. But the people who are actually in brackets that high
don't pay that.
They don't pay anywhere close to that because they are capable of hiring professionals who use the tax code to their advantage, and they're paying a much, much lower rate.
Well, when you talk about the advent of like CEO compensation, part of that was born in the fact that the highest federal tax rates were so high that they stopped paying CEOs in income tax and started paying them with stock options and stock compensation.
Right.
A lot of that was born out of the fact that income tax rates were so high that CEOs didn't want to get paid that much because they were going to have to pay this much in taxes. So they started getting their money in, tax compensation. You can say that's good, bad, or indifferent. It is what it is. That's what happened, and it's totally understandable why it happened. Anybody that, if you tell me the rules of the game, I'm going to play by the rules of the game, and most of these people did.
Yep.
And then they got, you can call it a loophole all you want, and I hear that a lot. It's really not a loophole. It's just that was the tax code that they were given.
That's the way it's written. But I want to go on to it. So we talk about what the highest tax bracket is. Very, very few people even touch that number. And the people who have the kind of money that would cause them to do that, they're not paying that kind of money now or back in the 50s when these rates were so high. But go to the other side. What is the lowest marginal tax bracket? Currently, that's 10%. It's been that way since around 2000, right? But that is also the lowest that the lowest tax bracket has been since the beginning of World War II.
Yeah.
Right. It has been above 10%. So even the lowest income people, their marginal tax bracket is still lower now than what it has been since World War II, where, prior to that, it was very, very low, a couple of percent.
So why is any of this important?
All right.
Well, it's because these tax rates have been made permanent, at least, knock on wood, for the foreseeable
Until the
future.
next president, right?
Until the next president or the next Congress, and who knows who that might be. Obviously, administrations change, and usually there's some level of tax policy that's adjusted with a new president or when a new president comes in. But as of now, and this is all the data that we have to work with, as of now, there is not going to be any tax increases in the foreseeable future at the federal level.
Right.
Okay? So that's important. So when you're trying to do tax planning, at least in the next 5 to 10 years, we have rates at pretty historical lows. It might be worth it just to if there's no prospect of rates going up in the near future, then that decreases the effectiveness of doing some of these Roth conversions.
Right.
During your lifetime. And I'm going to keep coming back to that, right? I keep saying during your lifetime.
You're teeing it up. I think everybody's knowing something's coming.
Yeah, and I'll come back to that as we get towards the end. But the reality is most RMDs too, when you get to RMD age, they're not that significant up front. So what the value of your 401ks and your IRAs and qualified retirement plans would have to be, and you're talking about multi-millions of dollars, they would have to be that large in order for you to really see a significant increase in the tax liability that you're going to have to pay strictly because of your RMDs. Another thing that's noted too is that if you're working with someone like us or anybody worth their weight, as far as a financial advisor is concerned, they're going to tell you, yes, any spending that you have to do in retirement should be coming out of your qualified retirement plans, not necessarily as quote unquote conversions, but yeah, you need to go buy a new car. Well, take it out of your IRA. And, we'll go ahead and do the tax withholding, but you need to start drawing that down over time, and you can start doing that in pieces without necessarily having to do the conversion in and of itself on money that you don't need, right? But money that you do need, make sure you're taking it out of your qualified retirement plans and start spending those down so we can potentially over time reduce what you're going to have to pay in RMDs. But for the most part, RMDs are not going to be bumping people up into the next tax bracket. And that's kind of the fear that a lot of people have, and that's the fear that's sold by a lot of people in our industry. And the reality is, the first couple of years of your RMDs, you're paying, 3-4%?
Yeah, somewhere in that ballpark,
Yeah, you don't really start having to pay 8% in RMDs until you get closer to your 90s.
Which kind of comes back to that argument of if you don't live into your 90s, yes, we have to plan that long because of longevity risk. But if you don't make it that far, most people don't, then you're never going to hit those big numbers, right? And remember, when somebody inherits this money, non-spouse, they're not subject to the RMDs like you are. They're subject to a 10-year rule as long as they get the money out within 10 years, right? So I think I figured out the area that I skipped, and I don't have my readers on, and I'm looking at your handwriting, and the letters are just big enough there. I'm pretty sure I figured it out. There is a different tax bracket that is a consideration here. And it
Very
only
much.
applies to people who are 65 years old and older because they have already filed for Medicare. There's this neat little thing called an IRMA tax. It's IRMAA, I think.
Yep.
I don't remember what it stands for. Feel free to look it up. We've looked it up in class before, and it immediately pops out of your head. So here's the concept. Once you are filing for Medicare, right, so age 65 and greater, if your income is above a certain point, then you have to pay an additional tax every single month on your Medicare Part B and on your Medicare Part D premiums. So that would be your doctors, the people that help you, non-hospitalization type things, and your prescription medications. That's the D.
Yep.
All right. So here's where it becomes really nasty when you start doing these Roth conversions if you're not careful. The brackets for IRMA are different than the taxes, than the income taxes. They fall on totally different things, and the calculation is different. So the amount of money in which you have to pay taxes, where that bracket that you fall in, is what we call AGI, or adjusted gross income, right? So that's where you take your credits and you reduce it from your income and all that. The deductions come after. But in the case of the IRMA tax, they use what's called a MAGI or a MAGI, depending on who you talk to. That's modified adjusted gross income. And that number includes some different things, including non-income taxable income. So, for example, monies that you have coming in from brokerage accounts where you actually had some capital gains, that's going to be included in that number. Monies that you have coming in from rental property that you own, that's going to be included in the MAGI number. And because you're falling into a different set of brackets, you can cause that to go up. Now, let me explain what's going to happen.
It also does not include deductions.
Correct. That's exactly right. The
and that's a
deductions
big
are after the
one. Yep.
fact. And you're right. That's a big one. So let me explain how this is going to work. So this is the year 2025. When you filed your taxes earlier this year, or here in Kentucky, there's people who still have not filed because they're not required to till November. That's another mess.
I just got mine done, actually. Yeah.
I just finished mine last month, I think.
I had to write those checks a couple weeks ago. So, yeah.
So if you're filing this year, you're filing your 2024 return. Okay. So in 2024, let's just say for argument's sake that you're 65 or over and you did a Roth conversion. And that Roth conversion didn't bump you into the next tax bracket for income purposes, but it did bump you into the next IRMA tax bracket. So you now have an additional payment, and it's in the hundreds of dollars
Per month.
on both your Part B and your Part D. Mm-hmm. That kicks in 2026. They can't kick it in 2025 because you're just filing. That's good for the entire year 2026, and it'll stay that way until you refile your taxes and you drop that number. And then it goes in the next year. So you're committed to this for a full year, and it's a 2-year delay, basically.
Yep.
So people forget that it's coming. Now, keep in mind something else. If you're married and you get that little penalty pop in on there, remember, hundreds of dollars per month, it's for each of you, right? So if you're, say, 75 years old and your spouse is 73, now you've got that IRMA tax on both of you in the phrase of hundreds of dollars a month because you did a Roth conversion that you're probably not going to live long enough to get a benefit out of because, and I'm going to steal something I know you want to talk about later, because you love your kids so much you want to pay their taxes for them. And that's that's the other problem with IRMA. People don't think about IRMA. If I remember correctly, that tax came out as part of the Obamacare healthcare thing that came out back in the early 2000s or 2010s. So be aware, and this is the reason we use the phrase comprehensive planning, which we both hate. But every decision that you make impacts a lot of other factors. So when we're doing these Roth conversions later in life, there are a whole lot of pain points that are kicking in here that you're not necessarily aware of.
There's also the additional 3.8% Medicare surtax.
Oh, that's another fun one. That's if you're in the 20% long-term capital gains bracket.
Net investment income tax too. So if you start realizing too much income or too much, so that's another thing that could bump you up into another tax bracket. So every decision you make, and we've called this the tax torpedo. I've heard it referred to as
exactly.
that. You can make one decision around taxes, but it's going to affect several different other things in your retirement plan.
Mostly negative, by the way.
Well, yeah. So when you start talking about anything in taxes, it's never positive, right? But they're all considerations that we have to take into account when we're making any decision around doing any type of a Roth conversion.
Yeah.
So we've teed it up. When do you do a Roth conversion? And you just said it, right? And I've been saying, well, during your lifetime, you're probably not going to benefit.
Right.
And in most scenarios, most of the clients that we have, in most scenarios that we run, it does not benefit our clients during their lifetime to do Roth conversions.
Okay, so when do you do it? All right, number one, the younger you are, the better off it is to do a Roth conversion. That's kind of the obvious one, but define younger. That's a little tough.
I'll even go a step further than that. The time to do tax planning is not when you retire.
Yeah.
And I know we have to do tax planning, and we do, and it's important, so don't misunderstand.
The time to start.
The time to start doing tax planning is when you get your first job.
Yep.
The younger you start doing long-term tax planning, i.e. contributing to Roth and also contributing to taxable brokerage accounts, in addition to your qualified retirement accounts that are going to grow pre-tax. If you're able to start doing those things at a young age, you are going to prepare yourself so much better. You're going to be, or you're going to spread out your tax liability in retirement far more effectively than if you just throw everything in a pre-tax 401k and get the company match. 100%. And I say this all the time. Not that there's ever a perfect portfolio by any means, but the closest thing that I see to one is someone walks in the door and they're ready to retire and they said, okay, I've got a third of my accounts in Roth, I got a third of my accounts in pre-tax, and I've got a third of my accounts in a brokerage account. Right?
Boom.
A third of my portfolio. It never happens that way.
No.
You never see that, right?
That's what we dream about, right?
But if you could have a third, and a third between those three different types of tax accounts, and I always say this too, most people think about their 401k as like an investment. Your 401k is not an investment. Your 401k is a tax code.
Yeah.
Your IRA is a tax code. It's a cookie jar. It's where you put the investments. But what's important about the 401k or the IRA or anything that has Roth in it is the way that those investments are going to be taxed.
Yeah. It's all about the taxes.
And so if you're able to start preparing at an early age to spread out your tax liability by spreading out or diversifying the location of where your investments are in different types of accounts that are going to be taxed in different ways, that is the most effective way to do tax planning in retirement is when you were young. Okay, all that to be said. Effectively, you're already in retirement. What do you do now? Well, you made the joke earlier, and I say this to clients all the time. When we start talking about Roth conversions, the number one question that I ask clients, and I can give you a list of clients, right? And they've all heard me asking this question. How much do you love your kids?
Do you love them enough?
And they always laugh, and they're like, what do you mean? Of course, okay, well, do you love your kids enough to pay their taxes? Because when you are doing Roth conversions, the people that benefit the most are going to be the beneficiaries of your accounts because they inherit any Roth conversions, right? They inherit any Roth money tax-free. Huge benefit, so I'm not downplaying it.
Sure.
It's a huge benefit from a legacy planning perspective. But I just want clients to understand up front, if we start talking about Roth conversions, in your lifetime, you're not going to be the one that benefits the most from this. It's going to be your kids.
But it's an interesting point because, number one, you're right almost all the time on that one. But occasionally, it actually doesn't benefit you at all. And I'm thinking about a specific case that I worked, and she probably is listening to this, and she knows that I use her as an example. So you know who you are. If you're out on your walk and you're listening to our podcast, I'm talking about you again. This is a widow. She has a relatively high income from pensions.
Oh, I know.
You know who I'm talking about. And she and her husband, during their working years, they were diligent savers. They did a fantastic job. The problem is they saved so much that they're not capable of spending it all. And now the pensions that she receives are greater than the amount of money she spends. So we've spent a lot of time. We've been working together for years, and it's all been about, do you want people to inherit this money when you're gone, or do you want to see them enjoy it? And she does want them to inherit a little bit, but she wants to see them. So we've been spending this money down. But she brought the conversation up. This has been several years ago when this whole Roth conversion thing was on every podcast and every news article and everything you could read in a magazine.
Because tax rates were going up in 2026.
Right, because they were going up. So she said, Chris, I think I have money that I'm never going to spend. The vast majority of it is qualified, meaning it's IRA, 401k type money.
Sure.
She said, I think I'd like to do some Roth conversions, and I'm willing to eat the taxes in a higher bracket so that my kids, she has 2 kids, they're both married, and they both have 2 kids. It's very balanced, so that they don't have to pay all these taxes. I said, okay, great, let's run the numbers. And we ran the numbers, and we did find, okay, here's what we can do without increasing your tax burden to a different bracket. We did run into an IRMA discussion, which kind of shut it down. But even then, she was like, can you partition money to pay that extra for a year? I said, sure, I can, right? But this comes back to, and we've discussed this before, you need to get your kids involved in your planning if they stand to inherit, because we were prepared to do it. Okay, we had our number. We were going to convert this amount. We had our plans for the following 5 years, right? She's in her mid-80s now. So we had that all laid out. And we said, okay, here's what we're ready to do. Now, let's get the kids and the kids' spouses on the phone, right? Mm-hmm. So we got them on the phone. So this was a fairly big Zoom call, right? And we said, look, here's what we're wanting to do. And I walked them through. Here's what mom is thinking about doing. Here's why we want to do it. She wants to pay your taxes for you so that you inherit tax-free money, because that is going to change your lives. Now, what's interesting here is the kids and the spouses are all teachers. So we talk about how teachers are underpaid for what they do. Well, teachers make decent money in the grand scheme of things. They don't make enough for what they have to put up with. But the point is, they're all in a lower tax bracket. So they brought this up. We did the math. The taxes that she would pay were greater than the taxes that they would pay if they inherited taxable money, even with the 10-year window. We went through and did all the math. The Roth conversion benefited no one. It didn't benefit mom. It didn't benefit the kids.
Yeah.
You know who it benefited? The IRS.
The IRS.
They were the only ones who come out on the winning side of this. So, and this is long before, we didn't know that Trump was going to run again for sure, much less get elected and push through this tax cut. We didn't know what was going to happen when we had this conversation. So we were all working under the assumption that taxes were going to go up and Roth conversions are all this wonderful thing. And we proved without question in this case that a Roth conversion would harm everybody except for the IRS.
Yeah.
And I brought that conversation, that statement that I make all the time out there. I don't care what your politics are. I don't care who you cheer for or cheer against. Everybody agrees that every dollar you give to the IRS, some of that money is going to be spent on something you don't like. So don't give them any more than you absolutely have to.
Some of that money is going to be spent on something we don't like. Right?
Some of it, right.
As opposed to the vast majority of it. But that's another conversation.
All right, yeah. Well, that's another one. So let's take a break if you think it's ready. I want to talk about Little Book for a minute. I want to explain that look that I got on my face that you identified, especially for those who are just listening. What do you think?
So it's interesting. This is going to sound kind of funny when I say it. So the very first taste, there was a lot of chew.
Oh yeah, this is hot.
There was a lot of chew. It was pretty hot on the first taste, and then every taste thereafter has gotten a little bit better. Mm-hmm. Now you could say, well, yeah, you keep drinking more, it's going to taste better, right? But
or you're just numbed.
Maybe I'm just numb. Maybe I needed that first sip to kind of numb my palate. But ever since that first sip, it's been smooth. There's a lot of flavors.
Okay, it's got all the traditional bourbon flavors, the caramels and the oak,
it's bourbon,
all that stuff.
Yeah, I mean,
it's bourbon.
There's nothing unique necessarily about it. It's very good. It's very flavor heavy, but it's not like it's somewhere. I mean, it's not heavy. It's not. There's nothing.
After that first hit, it doesn't drink like an extremely high proof.
Well, even then, it was all in my palate. None of it. There was no hug down the throat. It was all in my palate. So it's a remarkably smooth for 121. It's very very smooth. What's the price tag on this?
I'm going to be real honest with you. I don't remember.
Okay.
So it's one of those price points that the people who are going to be willing to buy this, they could price it up $30 and people would still buy it. If they knocked it down $20 or $30, probably would not increase the number of people that would be willing to pay for it that much. Please don't quote me. I want to say this is around $130 retail, but I may be dead wrong. I just don't remember.
Yeah.
I will tell you that, like I said, I get all the traditional bourbon flavors, but I get a heavy amount of butterscotch. And I'm really loving that. I love the butterscotch flavored stuff. That's probably the blending process that's causing that. And, there's some older ones in there. The face that I made. So you were talking, and those who were watching. I put when I still had a good ounce and a half left in my glass. We typically start with about a 2-ounce pour, by the way. I had about an ounce and a half left in my glass, and I put 2 drops of water. 2. I was very specific about that.
I haven't even diluted mine, honestly.
And when I did that face that I made, I got the most wonderful smoke flavor, like a smoked cocktail, right? And it caught me off guard. And now I can't reproduce it. It was just that one flavor. It's still there, but I'm searching for it now. Then I put 1 more drop in it, trying to bring it out. The butterscotch is just almost overwhelming. It's candy, but it's like a spicy candy. You know what I mean? This is not something that you would want to drink frequently. It is not something that you would want to drink a lot of. I would not even consider putting this into a cocktail.
No.
Now, full disclosure, when you get into the 120 plus proof stuff, putting that in a cocktail is dangerous. And I'll give you an example of what I mean by that. A couple of weeks ago, it was a Friday night, got home. One of the kids was out doing something. Actually, I think he was working. The other one was at a football game with his girlfriend. It's just my wife and I sitting there, and it was a beautiful night. And we sat outside around the pool, and I had myself an old-fashioned, which I'm a big fan. And I made it with a bourbon that was like 126 proof. Okay? Fantastic. It was so good. When I got finished, I went and made another.
I'll have another.
I'll have another.
Yeah.
I've only had 2. Normally, that kind of thing is not going to faze me, right?
2 old fashions, yeah, that's not that bad.
Ooh, this one, and I had a little bit to eat.
Well, if
this
you're making
was before
them,
dinner.
Well, if you're making them at home, you're probably making them stronger than if you were at.
But oh my gosh! And it's normally, what I would normally make a cocktail out of, typically around 100 proof. That usually is kind of the sweet spot for me. Now all of a sudden I'm in the mid 120s. There's a whole lot more alcohol there when you figure, I've got 4 ounces in each one of these drinks. I've had 8 ounces in about an hour and a half. I told my wife, I said, she said, let's go inside and fix some supper. And I said, I think I'm going to sit here for a little bit because I'm just going to sit here and relax and let this burn off a little bit. And I told her what I'd done, and she laughed at me and said, well, don't use that high proof stuff. So it does make, when you get into the high proof stuff, this would make an outstanding cocktail. This would be a wonderful old fashioned, but I wouldn't do it. Not just because of the cost of the bourbon.
It's too many flavors.
Too many flavors going on, and you don't realize how much alcohol is in a cocktail because it's mixed in with the sugars and the fruits and whatever else you're putting in there. So just my little commentary on it. I would tell you that I love this stuff. Side by side with previous years, I don't know that it's better or worse. They're all different. I love the presentation, with the box. And I told you what one of my buddies did with it, with turning it into a makeshift smoker. Really, really good stuff. The only complaint that I've got is it's over that fairly common price point that you talk about in that $60, $65 range. You are going to spend more money on that.
Oh, yeah. Yep. So, I mean, it's good. It says, it says on the label here, I don't really taste the butterscotch. It's very smoky to me and a lot of charcoal. Mm-hmm. Like
maybe that's what I was picking up. It just tasted like, like when you smoke meat, that wonderful smoky. I love that. So
Yes, that's what I'm getting a lot of. But no, it's very good. I like it a lot. I'll never buy it.
But
but I'm cheap though. So
we were talking about that on a podcast a few weeks ago. I was going back and I was kind of listening to it and critiquing us so that we can get better. And I made the comment, if you don't like to spend a lot of money on bourbon, but you like the good stuff, make sure that you're friends with people who have collections and like to invite you over or like to do podcasts or, whatever the case is. And then when they bring it in, enjoy it.
That's it. It's always funny. I got something far better than a boat. I have friends and family with boats.
Exactly.
I have something far better than a lake house. I have friends and family with lake houses.
You don't have to pay the taxes on it either. Speaking of taxes.
Yeah.
Yeah, absolutely.
I don't need any of that. I'll just use yours, right? I'll just drink your bourbon. That's totally fine. And I'm happy to be a leech.
Happy to oblige me.
I'm happy to be a leech and enjoy it with you. And yeah, I'm 100%. So maybe that's what we need to start doing though, is maybe start looking at some bourbons that are more accessible.
So
maybe at a lower price point.
You know what? I just had an idea. And if you think this is a good idea, just post something in the comments if you would. Maybe we bring in two and we blind them.
Yeah.
Right. So one of them is a $25, $35 bourbon. The other one is a $125 bourbon. Put them next to each other and see if you like one better than the other. Is it actually worth the difference in price? Or you know what? I can think of a couple of fairly inexpensive ones.
Oh yeah,
that are really good, and probably the gold standard for cheap and really good is Old Granddad 114, which we've talked about on the show before. We did the Old Granddad 16 year.
Yeah, I was going to say we did. Yeah.
Which is the same bottle and everything, but the 114 you can find that in any liquor store in this country. Yeah. Certainly in the Kentucky area, if they're charging you $30, they're ripping you off.
Hey, if you want,
right?
I can tell you the good cheap ones. I know the good cheap ones,
and it's fantastic. So. It's easy to find. So maybe we'll do a couple of less expensive ones, and see what you think about that.
I'll tell you another thing too is we need to bring in like a tequila one time too.
I can do that as well. Although I have to be careful with tequila. There's a past.
Well, I'm talking about sipping tequila. I'm not talking
I understand.
About shooting tequila like you're in college. So. Anyway,
we could take a week off and maybe do a rum or a tequila or something like that. And people might. I'm not doing Scotch. I can't stand Scotch. I'll do Irish whiskey, but not Scotch.
Well, we're veering off track now.
Yeah,
so,
we're getting way off track.
So all that to say, to kind of wrap up on Roth conversions. Not to say that Roth conversions are not valuable. They can be very valuable, depending upon the circumstance. But what's very interesting, and we've been doing so many of these for so long, and especially now that the tax rates are not going up next year, they just quite frankly are becoming far less effective. Yeah. And it goes against conventional wisdom, and once again, I hate conventional wisdom in all. Maybe that's a contrarian in me. I have a very contrarian personality. Mm-hmm. That's not always going to be the best thing in the world, probably, but in this case, it just doesn't always fit for most people. Yeah. And they've been fed Roth conversions for so long as a tax planning strategy in retirement, and it's just not nearly as effective as it used to be, to be perfectly blunt. Not to say that it can't be, but that's why you need to call, schedule, come on in, and we'll review your plan with you to see if it does make sense. But even if it doesn't necessarily make sense for your lifetime, if we want to set up some type of a legacy plan or some type of a gifting strategy to help mitigate some of those tax issues, there are other ways to do that outside of strictly just Roth conversions. So I think that's
Amen. I couldn't say that better.
So all that being said, thanks for joining us. We'll see you next time.